Hello traders, you're welcome back to the Forex Geek channel. In this video, we are diving deep into statistical signal trading, okay? A strategy that leverages historical data and probability models to help identify high probability trade setups. Unlike traditional technical analysis, this method isn't just about chart patterns or indicators. It's about statistical significance and data-driven decision making. So if you want to refine your entry and exit points, filter out noise, and focus on reliable trading signals, then stick around. And before we jump in, make sure to hit that like button and subscribe to the channel for more advanced trading insights. So what exactly is statistical signal trading? This strategy involves using historical price data, probability models, and market behavior analysis to make informed trading decisions. Instead of relying on subjective interpretations of price action, traders use statistical significance to confirm signals and improve accuracy. Statistical signals can be derived from multiple sources, including price deviations from the mean, that is identifying when an asset is overextended compared to historical averages. Also, probability shifts, which involves spotting moments when price movement exceeds expected ranges. And then statistical signals can also be derived from probability distributions, using past data to estimate the likelihood of future price movements, and then market anomalies and outliers, which involves detecting patterns that stand out from normal behavior. Now, let us break it down step by step. The goal here is to analyze price movement in a statistically meaningful way so that we can enter and exit trades with confidence, okay? So first of all, the mean reversion approach. One of the key concepts in statistical signal trading is mean reversion. The idea that this is the idea that price tends to return to its average over time. So if an asset price deviates significantly from its historical mean, traders might look for a reversal opportunity. For example, let us say a currency pair has an average daily range of 50 pips, but suddenly moves 120 pips in one direction without a strong fundamental reason. A statistical trader would analyze whether this move is sustainable or if it's likely to revert back toward the mean. All right. Now, let's talk about volatility-based trading signals. Volatility plays a major role in statistical signal trading. By analyzing standard deviations or tools like Bollinger Bands, traders can identify when an asset is experiencing unusual price fluctuations. All right. When volatility expands, as displayed by the Bollinger Bands, it signals that a strong move is underway. When volatility contracts, it often precedes a breakout or reversal. So understanding these shifts can give traders an edge when entering or exiting trades. Now let's talk about filtering false signals with probability models. Not all signals are created equal, okay? Statistical traders use probability models to determine whether a trading setup has a strong chance of success. This could involve backtesting historical data, calculating probabilities, of price movement, or even using machine learning to refine signals. For instance, if a certain pattern has historically resulted in a continuation move 75% of the time, that provides an edge over random guessing. So why should traders consider using this approach over traditional technical analysis? The biggest advantage is that it removes subjectivity from decision making. Instead of relying on personal interpretation of patterns, you rely on hard data. Another key benefit is risk management. By understanding historical price movements and probabilities, traders can set stop losses and take profits based on real statistical evidence rather than gut feelings. Finally, this strategy works across multiple markets, whether you are trading Forex, stocks, or crypto. Statistical signals remain relevant. All right. Now, if you want to start using this strategy, here's what you need to do. First of all, gather historical data. Okay, you can use tools like TradingView or MetaTrader to analyze past price movements. Then identify patterns with statistical significance. You can look for price behaviors that consistently repeat over time. All right, and then use probability models. You can incorporate statistical tools to refine your decision making. All right, and then also very importantly, test and refine your strategy. Okay, it is very important that you always backtest your approach before using it in live trading. All right, you backtest it and practice on demo accounts. Ensure that it's giving you the expected results. Okay, before you consider moving onto your live account. All right, and that is a wrap for that's a wrap on the statistical signal trading. This method allows traders to make smarter, data-driven decisions rather than relying on guesswork. Now, if you found this video helpful, smash that like button and subscribe for more trading strategies like this. Okay. Meanwhile, what do you think about this approach? What do you think about the statistical signal trading? Let me know in the comments below. Okay. Happy trading, and I hope to see you in the next video.